Welcome to the rise of private equity secondaries, unlocking liquidity in illiquid assets. Today we're diving deep into a fascinating and rapidly evolving corner of the financial world. The private equity secondary market, once a niche, has exploded into a multi-billion-dollar powerhouse. It's revolutionizing how investors manage their private equity portfolios, offering unprecedented liquidity for traditionally illiquid assets. So what exactly is the private equity secondary market? At its core, it's where existing private equity fund interests or portfolios of private companies are bought and sold. Unlike the primary market, where investors commit capital directly to new private equity funds, the secondary market deals with pre-existing commitments, such as existing investment in a particular asset class or sector. It's akin to a stock exchange, but for private investments. The growth has been staggering. The secondary market reached an estimated $162 billion in transaction volume in 2024, with projections indicating it will surpass $175 billion in 2025. To truly appreciate its current standing, let's briefly look at the history and evolution of this market. Initially, the secondary market was a small, opportunistic segment, primarily driven by limited partners seeking early exits. Over time, it evolved, gaining sophistication and embracing more complex transactions like GP-led deals, transforming into a mainstream component of the private equity ecosystem. Several powerful forces are fueling this unprecedented growth. Firstly, limited partners, or LPs, are increasingly seeking liquidity to rebalance portfolios or manage capital calls. Secondly, general partners, or GPs, are actively using secondaries for portfolio management, extending hold periods for strong assets, or exiting weaker ones. Lastly, the overall maturity of the private equity market has created a robust environment for secondary transactions. Let's delve into the mechanics of LP-led transactions, the traditional backbone of the secondary market. This process typically involves an auction where LPs sell their fund interests to a secondary buyer. This requires careful due diligence, extensive data room review, and often consent from the original fund's general partner. LP-led secondaries, accounting for $87 billion in 2024, are driven by LPs who want to gain liquidity, rebalance their asset allocation, or exit underperforming funds. Increasingly, even first-time sellers are entering this market as it becomes more widely accepted. On the other hand, GP-led transactions, totaling $75 billion in 2024, involve the general partner initiating the sale. These often take the form of continuation vehicles, allowing the GP to roll existing portfolio companies into a new fund with new capital, extending the hold period and generating new carry for the GP. Continuation vehicles are sophisticated tools. They can be single asset, focusing on one high-performing company, or multi-asset, grouping several companies. While they offer benefits like extended hold periods and a quote-unquote carry reset for GPs, careful consideration of economics and potential conflicts of interest is crucial to ensure alignment with all stakeholders. For sellers, the benefits are clear. Secondaries provide much-needed liquidity for typically illiquid private assets, allow for portfolio rebalancing to meet strategic goals, and can even help mitigate the J-curve effect, providing earlier returns than traditional primary fund investments. Buyers in the secondary market also reap significant rewards. They acquire fund interest with a shorter remaining duration, reducing blind pool risk as they have visibility into the underlying assets. Secondaries offer immediate portfolio diversification and, in many cases, the potential to acquire assets at a discount to net asset value. Pricing dynamics are crucial. While the average pricing in the secondary market typically hovers around 89% of net asset value, this can vary significantly. Factors influencing pricing include the quality and vintage of the underlying assets, the specific fund manager, and whether it's an LP-led or GP-led deal, especially for multi-asset continuation vehicles. Valuing secondary interests is complex. Methods include using the fund's net asset value, fair market value assessments, and independent third-party appraisals. The influence of GP marks and audit lags can impact reported values, requiring buyers to conduct thorough, independent due diligence. The secondary market is expanding beyond traditional private equity into other alternative asset classes. Infrastructure secondaries reached $9.1 billion in the first half of 2024, and private credit secondaries hit $4.6 billion in the same period. Secondary funds are distinct from primary funds. They have a different life cycle and capital deployment cadence, often buying existing interests rather than making new commitments. Their structures are designed to capitalize on specific secondary market opportunities, offering a different risk-return profile. Despite its growth, the secondary market is not without challenges. Its complexity demands specialized expertise, accurate valuation can be tricky, And there's always the risk of adverse selection, where sellers offload underperforming assets. Regulatory scrutiny is also increasing, adding another layer of complexity. Real estate secondaries are also gaining significant traction. As more real estate funds mature, LPs and GPs are increasingly utilizing secondary transactions to manage portfolios and unlock value, though these transactions often come with unique fund structures and transfer challenges. The future of the private equity secondary market looks incredibly promising. We anticipate continued robust growth, increased acceptance across all investor types, and significant product innovation, leading to further market maturation and sophistication. Looking ahead to 2025 and 2026, we foresee exciting emerging trends. This includes the rise of fractional secondary platforms, tokenization of private assets, the increasing use of AI in deal screening, and the expansion of secondary access to retail and private wealth channels. In conclusion, the private equity secondary market is a dynamic and essential component of the alternative investment landscape, providing critical liquidity and portfolio management solutions. This video is for informational purposes only and does not constitute financial advice. Always consult with a qualified financial professional before making any investment decisions. Thank you for watching.